Good morning, students. Welcome back to the session on Ind AS. So we are continuing today with our discussion on financial instruments. In the last two sessions, we have been discussing about the basic concepts. Again, I would say that is all about financial assets, financial liabilities, and equity. In the last session, we focused on one of these items, which was financial assets. And on financial assets, we got into the discussion related to the classification. And we also touched upon one aspect that was related to measurement. Because as we have discussed, the classification is relevant, or the classification is something which determines the subsequent measurement of any financial asset. Yeah. So I'm again not getting into too much details around whatever we have discussed. I'm hoping that you are all through in terms of your understanding about whatever we have discussed. So quickly, before I start, a couple of things which you can just answer. One, that is about homework. So yesterday I gave you few illustrations for practice. So I'm just hoping that you would have completed the homework. In case you have any query on that, you can please share that with me, and also please confirm whether you have completed the homework or not. Any of the challenges that you might have faced, please let me know. The other thing is about the discussion that we have had yesterday in relation to the amortized cost. So in the part related to the amortized cost accounting that we started with, we could not complete everything in relation to amortized cost accounting, because idea was really to get into the conceptual understanding of that accounting. So though we are planning to cover that in more detail today, but still, if you have any questions around that amortized cost concept, the way this accounting is required to be done, we can have a discussion on that part first of all, before we can take up further points for today. Yeah. So any questions, any doubts in case you will have on this, we can just have a discussion on that part first of all, and then we can move further. Yeah. So in the meantime, I'll just do a quick recap of the things we discussed yesterday in terms of the specific points. That was about the details in respect of the business model, contractual cash flows, SPP, etc. About the business model, some of the important things that we need to remember is that business model is all fact-based. We cannot get into the intention of the management. We cannot just say that management is thinking to do this, and that's why we can just consider that aspect related to business model. Number two, contractual cash flows, or this characteristic of contractual cash flow, this has to be tested, which again has to be determined based on the arrangement, based on the terms of the contract. And in respect of the terms of the contract, what we need to check is that whether the return that the holder will get is limited to the interest component, which should match with the interest component which will exist in any basic lending arrangement. Or in terms of matching, we can say it should be consistent with that interest which exists in basic lending arrangement. So these are the key points for us to always remember. In relation to the business model, because it is fact-based, so that's why we also understood there could be certain changes in the business model. And because the changes may arise in the business model, so that's why some of the financial assets which might have been classified into a particular category may have to be reclassified into a different category. So that reclassification is one part that we only need to just know. The details around it we'll just discuss as to how that reclassification can be done later on. Then comes the other important point, that is about accounting under the amortized cost concept, because that is different from what we see or what we might have done so far. So that's why I'll now get on to the accounting once again for that amortized cost. So in case you will have any query, we can have a discussion on that part as well. All right. Now moving back to today's discussion. So we had this example wherein security deposit was given for 10 lakhs, wherein the security deposit was given for 10 lakhs. It was for a period of 5 years. After 5 years, 10 lakhs would have been received, and during this period, we discussed that the interest will be accreted, and there will be a component which will get generated at the beginning of the year because of considering the present value of this security deposit. So I think this amount was 5,70,000. So this was the present value of security deposit. And then we also had this prepaid expense equivalent to 4,30,000. Yeah, clear? Okay. And then we discussed that year on year, this amortized cost will require accretion of interest on this and amortization of this particular expenditure. And we call this as a sort of deferred expenditure. Now coming to some more specific points in relation to any of this type of accounting requirement. In the first year, though we are clear on the accounting of accretion of interest, when the interest will be accreted in the first year, let me just get on to this computation only. In the first year, when the interest will be accreted on this, so the interest amount will be security deposit debit to finance income. And I think this was approximately 68,000. All right, this was approximately 68,000. Now, around this prepaid expense, we discussed that expense will be debited and prepaid expense will therefore get amortized. Now we need to understand about this prepaid expense. Now, prepaid expense is a general term, but in the financial statements, we cannot have any general term. We cannot have any general expenditure. It has to be very, very specific. Specific means it should reflect the nature of the transaction. It should reflect the understanding of the transaction which has been entered into by the entity. Now, if you just say that there is an expense which has been debited, there is a prepaid expense which has been recognized in the financial statements. Now, what is the nature of this expenditure? Till the time it will not have the nature of the expenditure, even though we will be able to take it to the P&L, we will not be able to classify it. Under which head do we classify it? Is that important to be known? Yes. Otherwise, in the financial statements, where do we place it? Where do we present it? That is not known to us. So now, standard says that this expenditure has been incurred in the lease arrangement. So this contract was that of a lease. Yeah. Because this was in the nature of a lease, that's why the expenditure should also be in the nature of a lease. So what do we call it as? We will say it's a lease expense. So we'll say lease expense debit to prepaid lease. And therefore, instead of just saying this is prepaid expense, we may make it prepaid lease expense. And in the first year, the numbers around it was 86,500. Again, I'm not getting into the exact computation. So this is year 1 and again this is year 1 and now a question may arise that if this is a lease expense, why is this accounting getting driven by this particular standard? So don't we refer to the standard on leases in relation to this? Will this not be recognized in accordance with the requirement of that particular standard? Yeah, because that's the immediate thought that will come to your mind. Why we will do the accounting like this? Now let's understand the way this transaction may have been structured. So I'm just trying to add some more facts to this transaction. In this transaction, initially a deposit of 10 lakhs has been given. And it may happen that the lease rental which are mentioned in the agreement are approximately, say, 25,000. per annum. For simplicity's sake, I'm just keeping it 25,000 per annum. Okay. Now, let's suppose these are 25,000 per annum. Then how do we do the accounting? We'll just consider these lease expenses on an annual basis. Correct? And because we will consider all of these lease expenses on an annual basis, what do? We will just take them to the cost in relation to the lease expense or in respect of a lease arrangement. Now coming back to this understanding wherein we have added the lease expense in the first year amounting to 86,500. In this case, what are we trying to do? In this case, in a way, we are increasing this lease expense in the first year. And why are we doing this? Let's understand this. In substance, the agreement may involve payment of, say, a lease expense of 86,500 plus 25,000. So what do we get? So in that case, what do we get? So if we take this amount of 86,500 plus 25,000, maybe the lease expense should have been approximately 1,11,000. Again, I am just getting into the approximate numbers. I am not picking the exact number. But intentionally, the lease expense was kept lower. Why? Because a deposit has been given free of cost. So this deposit in a way includes this deposit which is given free of cost, in a way includes this particular cost of lease expense, which won't have got recorded otherwise. If we would have done the accounting the way it's required to be done under Indian GAAP, then what would have been the accounting entries? In the first year, the accounting entry would have been very simple. We would have passed year 1 lease deposit or security deposit debit to bank, which would have been 10 lakh and 10 lakhs. And then depending on the requirements of lease or depending on the terms of the lease agreement under Indian GAAP, lease expense would have been recorded year on year equivalent to 25,000. Yeah, year on year lease expense would have been recorded equivalent to 25,000. But now things have changed. Now we are not limiting to 25,000. In fact, we are increasing this amount by 86,500, which will also change to some other amount in the second year, which will also change to some other amount in the third year, and so on. So this will keep changing. And up to the end of fifth year, this total amount would be recognized. Why? Because ideally, the lease expense should have been higher. Lease expense should have been charged higher, but that was not charged higher. Instead, that was kept lower. Why? Because of this arrangement of security deposit, which was given free of cost. But if we go with this model, what do? We will bring in the lease rental to its idle amount or to the amount at which this should have been recorded. Plus, because we are recording this at the amount at which this should have been recorded in substance, not really going by the terms which are mentioned legally or which are mentioned in the contract. In addition to this, we are also recognizing an interest income, because if the lease expense would have been charged equivalent to 1,11,500. How do we get 1,11,500? This plus this, the number that we just discussed. Okay, so if we bring the true value of lease expense in the first year as well as in the following years, what should we really do? We should also bring in the interest component, which in substance exists in this arrangement, because in this arrangement, other than incurring a cost of this as well as this, there is also an income which is getting generated for A. So we discussed that this is A limited. For A limited, an income is getting generated. What is that income? This is the finance income. And why is this income getting generated? Because ideally, he should have paid a security deposit of 5,70,000 and he should have charged interest on this security deposit at the market rate. So which in our case was 12%. If he would do this, then this accounting, the way we have done now, will reflect in substance, will reflect the true arrangement which would have been entered into two parties, which would have been entered into between two parties. Which are those two parties? A limited and B limited. So now A limited will say that I am required to receive this deposit. And because I am required to receive this deposit, that's why I will consider its present value. And on this present value, I will recognize interest income year on year. Plus the prepaid expense which I have incurred or which I have paid, actually that has been paid because that's an asset, should get into the nature of the same expense which is related to the contract. All right, clear on this? Now let's also understand what is the impact, because we have been discussing that by doing this accounting, we are actually looking at the substance of the arrangement. In substance, this has been the arrangement, and we are getting into the correct way of accounting. Instead of just not recording these two components, now we are bringing in two components. So that's why it's it's reflecting the substance. Now in this case, in the first year, what are we doing? If you look at the numbers, in the first year, we are recording, I'll just clear some of these. This is one, sorry. This is 1, 2, 3, 4, 5. So in the first year, we are recording an income of 68,000 and we are recording an expense of 86,500. Yeah, and this expense will continue on the similar lines. Correct? This expense will continue on the similar lines. Next year, then next year, then next year, then next year. Same amount will continue. So we can also compute this amount. Let me just quickly compute this amount. So we have 4,30,000 divided by 5. Yeah, exactly. If you have to look at the number, exact number will come out to 86,000. So I'm just changing this to 86,000. In the second year, this will be 86,000. In the third year, this will be 86,000. In the fourth year, this will be 86,000. In the fifth year, this will be 86,000. So all in all, if we take the total of all of these amounts, this will work out to 4,30,000. In the first year, interest income has been 68,000, but in the second year, this interest income will increase. Yeah. In the third year, this interest income will further increase. In the fourth year, this interest income will increase. Eventually, what will happen? This interest income will increase in a way that the total security deposit should move from 5,70,000 to 10 lakhs at the end of the year. That is what we discussed. Yeah. So the interest income, which will be recorded year on year, over a period of 5 years, what will be the total amount of that interest income? Again, same thing. 4,30,000. Yeah. Now, can you observe a point over here? Can you observe one very important point? What is that important point for us to assess? That if we look at the impact on the P&L in the first year, what's the impact? Difference between these two. Similarly, difference between these two. So even though year on year there will be an impact on the P&L, but if you look at the P&L of the 5 years, or in other words, if you look at the P&L over the term of this contract, what was the contract? Lease arrangement. The impact on the P&L is neutral. All of these over a period of 5 years, they are generating same amount of income and same amount of expense. So over a period of 5 years, the impact is neutralized. Or in other words, we can say there is no impact on the P&L if you look at the P&L over the life of the contract. So in a way, what are we just trying to do? We are just trying to bring in this aspect every year to reflect the substance of the arrangement. But we are not changing any of the numbers at the end of the arrangement, because at the end of the arrangement, the numbers have to be the contractual amounts only, because we cannot do the accounting which will exceed the contractual amount. Can we say that because of the accounting, instead of 10 lakh, A Limited will receive 11 lakhs at the end of the year? No, not possible. Can we say that because of the accounting, A Limited will receive 9 lakhs at the end of the year? No, because whatever is the contractual amount will remain same. The only thing which is about the accounting, which will reflect some of these arrangements, but that is possible only during the life of the contract. Okay. So with this, what is it that we make out? We make out that over a period of 5 years, P&L remains neutral. And that is why, in fact, I remember you had one query yesterday. Sir, will it have any implication from the deferred tax perspective? So you can now understand. In the first year, if you look at the amount of security deposit, at the beginning, what's the amount? 5,70,000. At the end of the year, what will be the amount of security deposit? Can you please compute and let me know? At the end of first year, what will be the amount of security deposit? 5,70,000 plus 68,000. So this comes out to 6,38,000. So I've just cleared the accounting entries which you would have passed under Indian GAAP. Year 1 end, in the balance sheet, security deposit would appear at 6,38,000. Correct? And the balance sheet will also show prepaid lease expense equivalent to, can you give me this amount quickly? Yes, all of you quickly tell me the amount. Prepaid lease expense at the end of first year, what will be the amount of prepaid lease expense? 4,30,000 minus 86,000. So this comes out to 3,44,000. 3,44,000. Okay, yeah. Now let's understand about tax base. I'm just slightly digressing from this concept because you had this query about the deferred tax. Now, if we look at the tax base, it may happen that the tax does not accept this accounting. Means they may not agree that at the end of year 1, security deposit should be taken as 6,38,000. They may say that as per the tax laws, this security amount should be 10 lakhs only. Yeah. Similarly, they may say that there is no prepaid lease expense as per the taxation laws. It should be nil. Now, if we consider these two, what do we get? We see that there is a difference between the book base and the tax base. So this is the book base, this is the tax base. So there is a difference between these two. And is this difference temporary? Yes. Why? Because if you look at the period of 5 years, this difference is only generated within 5 years. After the end of 5 years, what will happen? Security deposit amount will also get back to 10 lakhs or will become 10 lakhs. After which this difference will go away. So that's why this difference is reversible. Correct? And that's why this difference will become temporary difference on which deferred tax should be recognized. Clear on this? Yeah. Again, I'm not getting into the deferred taxation in terms of its details. That's not our objective. So our objective is to focus on this accounting. So if you have any questions around this accounting that we have discussed, please let me know, because with this we can now move on to some questions for practice. So if you have any questions, please let me know. Otherwise, we can get on to some more questions for practice. So we'll also look at the accounting entries with the actual numbers, and you'll have to solve all of them. So any questions, any doubts before we get on to that? Quickly. Yes, any questions, any doubts? Quickly, you may ask me. Yes, any questions, any doubts which you may have? No questions? All right, so then we can just move further and we can pick up illustrations. So we can now move on to illustration number 16, and this is page 12.82. Okay, so let's go to illustration number 16. And this is page number 12.82. It's the similar set of illustration, similar sort of illustration which we just discussed. And you may start solving this, please, all of you. You may start solving this. You may start solving this illustration. A Limited has made a security deposit whose details are described below. So there's a table in which details of security deposits are given. Make necessary general entries for accounting of this deposit in the first year and the last year. Assume market rate of interest for a deposit for similar period to be 12% per annum. So same set of numbers that we have. Due date in terms of security deposit, that means the date when this will be received back is 31st March 2006, and it's given on 1st April 2000x1. So that means the period of security deposit, period of this arrangement is 5 years, and it's a lease arrangement. So same thing which we have just seen. Discount rate is 12%, and the amount of security deposit is 10 lakhs. Again, the numbers are also same. So present value factor is also computed in the question and given to you. So you are not required to compute that. Though even if we are required to compute, we can solve it out. So we discussed yesterday. There's a formula for computing this. Correct? Yeah. So now in this case, what are you required to do? You are just required to pass the accounting entries in the first year and in the 5th year. So even though accounting entries are required to be passed in the first year and in the 5th year, what do you need to do? You need to get into the computation. Correct? Yeah. So I'll just wait for a few minutes for you to solve this and let me know the answer. In fact, the accounting entry for first year is something we have already passed. We have already discussed. The important thing which you need to focus on will be the accounting entry for the last year. You can just let me know the amounts which you will have for interest income and for this amortization of prepaid expense in the 5th year. So these couple of things you can let me know, and then I'll also start solving this? Yes, quickly. At the end of 5th year, couple of amounts you can tell. One, accretion of interest. Second, amortization of expense. What are those amounts? Once you are done, please share the numbers with me, and then I'll also get on to the solution. Okay. I'm just hoping that you're solving this. Yeah. I'm hoping you're solving this. You may please confirm this to me. You have started solving this. You're just required to compute the numbers of the 5 years, because the accounting entries we have already passed. So you can also easily pass the accounting entries for the first year. You may also add to this question the accounting entries for second year, third year, fourth year for your practice. Okay, you are not required to do that now. You can just give space in the solution and include the accounting entries. So with which your accounting entries for this complete contractual period will be included. Okay, so in case you want to do that, you can also include that. For the time being, whoever would have completed, please start sharing your numbers for the 5th year only. What is the amortization amount and what is the interest accretion in the 5th year? Okay, great. Preeti has shared the number for the 5th year. Preeti is saying that prepaid lease, I'm assuming that this prepaid lease is not prepaid lease, this is the lease expenditure in the 5th year. This is 86515. Okay. And in the year number 5, interest income comes out to 1,07,143. So that's the computation from Preeti. Okay. Any more computations from your side? Any more responses from your side? Yes, all of you. Preeti has on this and shared the numbers. What about others? You're done? Quickly, huh? You're done? Yes, I'm waiting for responses now. For the 5th year, I think it's very, very simple for all of you to compute. Huh? Quickly start sharing your responses. If you're facing any challenge, you can also let me know. Okay, so what we can do is we can now move on to the solution piece. Huh? So I'll take you to the solution. So we have this computation available in the presentation. So that's why I'm not recomputing the number. So in the first year, what did we do? In the first year, we discounted security deposit, and this came out to 5,67,427. Correct? And we have created an amortization schedule, a kind of repayment schedule. Can you see this? We have created that. Why do we do that? Because this will help us to work out our various numbers. Let's see how. In the first year, now we are starting with security deposit amount of 5,67,427, on which I need to add interest. So what will I do? I will add interest on this at the rate 12%. Correct? And which will give me a closing balance of 6,35,000. Okay. Then next year, I will start with this 6,35,000 on which again I'll add interest. Yeah. So this exercise I'll repeat every year. And because of this, eventually what will happen? At the end of 5th year, in this case, the years are different. So please don't go by the year. The numbers, everything remains same. In the 5th year, the deposit amount will become 10 lakh after adding all of these interests to 5,67,000. So in the 5th year, what is the amount of interest? 1,07,143, which has been shared by Preeti as well as Pujita. So Pujita has slight difference. I think this could be because of round off. And the prepaid amortization, the amortization of prepaid expense is 86,000 per annum. Now you can add to your notes that this amortization has to be on straight line basis only. A question may arise. You may have a question that, sir, on one side we are recognizing interest income on the closing balances, which is not on straight line basis, isn't it? Even though the amount of this interest on totality basis. So if you look at the amount of this interest on totality basis, let me just clear this part. In totality, this will come out to 4,32,573 only, which is matching with the amount of amortization of 5 years. Yeah. So you may have a question that can we not book the interest in same proportion in which booking the amortization expense, because of which the P&L will become neutral year on year also? No, that cannot be done, because that's not how you do the accounting of any asset which would be recorded at amortized cost. So accretion of interest, which we have been doing, this is how any financial arrangement will work. So let's suppose if you will take a loan from a bank, so bank will charge interest in the first year, and if that is not paid, then they will also charge interest on the same amount. Correct? Yeah. Which is more of a compounding sort of thing that is required to be done. Okay, clear on this? Yeah. So clear on the numbers, clear on the computations, clear on the accounting entries for all 5 years. Yeah. So this was all about amortized cost accountings. This is how amortized cost accounting is required to be done for the financial assets. Okay, all of you clear? Now, we can now move on to the accounting requirements for other categories. For other categories, as we have discussed, the accounting requirements are comparatively simpler. Why? Because in this case, we were required to do accretion of interest, we were required to do amortization of any sort of this prepaid expenditure, which will not arise in case of other classifications. Okay, so let's see how that will work. So what we can do is we can now move on to another illustration to understand that in more detail. Okay. So let's pick up illustration number 17, which is page number 12.84. Yes, if you can all go to illustration number 17 on page number 12.84. Accounting for financial assets which are bucketed under fair value through P&L. Can you all tell me, if the financial assets are bucketed under fair value through P&L, how do we measure them? Quickly. How do we measure them? Quickly, huh? How do we measure them? Yes, I'm waiting for a response. In case of fair value through P&L bucket, how do we measure financial assets? Quickly. Waiting for a response. Yes, we measure them at fair value with the resultant changes in the fair value going to P&L. Okay, so let's see. A Limited invested in equity shares of C Limited. A Limited invested in equity shares of C Limited on 15th of March for rupees 10,000. For rupees 10,000. On 31st of March, the fair value of equity shares was rupees 11,200. Now subsequently, on 31st of March, this fair value became 11,200, and the market rate of interest is 10% per annum for a loan of 10 years. So that's the understanding in respect of a loan. In case there's a loan for 10 years, then the market rate of interest on such loan will be 10% per annum. You are required to pass necessary journal entries for this transaction, analyze the measurement principle, and also pass the necessary entries in that case. Now, in this case, first of all, what should we do? We should determine from the holder's perspective, is this a financial asset? So we can say yes, it's an investment in equity shares. So investment in equity shares will mean that for other party, it will become an instrument in the nature of equity. So that's why, what do we call it as? Financial asset. That's there in the definition of financial asset. Okay, number one. Number two, the moment we say it's a financial asset, but we need to check whether it's amortized cost, fair value through P&L or fair value through OCI. Now, because A has invested in equity shares of C, can it become amortized cost? So we need to check the business model. So business model is held to collect. Yes, it's held to collect. But can we say the returns are SPPI? No, because these are equity shares. That's why the return which A Limited will generate from this investment cannot be limited to an interest which is consistent with basic lending arrangement. Correct? Yeah, that cannot be limited to that. So what will happen in such a case? It will go beyond that, or it may be significantly lower than that. It cannot be consistent with basic lending arrangement. So that's why SPPI will fail. The moment we say SPPI will fail, amortized cost category is not possible, and so is the case for fair value through OCI. So both of them will fail. So what are we left with? Fair value through P&L. So that means this is a financial asset to be categorized at fair value through P&L. Okay, yeah. Now, in this case, at the time of initial recognition, what do we do? In this case, question also says that there are certain transaction costs amounting to rupees 500 which have been incurred in addition to rupees 10,000. So maybe when A Limited was investing in shares of C Limited, A Limited was also required to incur costs for entering into that transaction. So any cost which is incurred for entering into that transaction is considered to be a transaction cost. Yeah. So we also need to deal with that transaction cost. How do we deal with that transaction cost? We'll also have to understand that. Yeah. So let's see what are the accounting entries which should be passed at the time of initial recognition. At the time of initial recognition, we'll go by the same understanding. First, financial asset has to be measured at fair value. Okay. So what's the financial asset? Investment in equity shares. Debit. What's the amount? 10,000. So 10,000 is also assumed to be its fair value until unless it's something else. Yeah. To bank. To bank. What is the amount which has been paid? 10,000 plus 500. 10,000 plus 500. So this will be 10,500. And what's the differential amount? The differential amount is transaction cost. Transaction cost debit 500. And where do we take this transaction cost? This transaction cost will be taken to P&L. So you should remember to include the narration, sir, please. So I'm not writing the narration, but you should remember that. Huh? Okay. Now, another accounting entry which you may consider passing will be the recording of this transaction cost. 500 and 500. So what you have done is you have just charged this transaction cost to P&L by doing this. So this is something which you do at the time of initial recognition. Now, for us, 31st March period numbers are also available. The fair value of 10,000 has changed to 11,200 at the end of the year. And do we need to do the subsequent measurement? Yes. In case of fair value through P&L, what do we need to consider? Changes in the fair value. So let's see how do we consider that. The change in fair value is what amount? Change in fair value amount is 1200. 11,200 minus 10,000. That means the amount at which it was recognized last. So investment amount will therefore increase. Now the investment amount is increasing. It's increasing by 1200. 11,200 minus 10,000. 1200. Correct? So there is an increase on this. And what is this increase? It's nothing but a gain. Gain because of fair valuation. To fair value gain on investment in equity shares. 1200. And where do we take this gain? This will also go to P&L. So this is the space for narration, and this is an accounting entry that we pass at year end, 31st March. And now we will take this fair value gain on investment in equity shares. $1,200 to P&L. So what are we doing in this case? We are transferring this to P&L account. Why we are taking it to P&L? Because this element belongs to P&L. So what's the summary which we can just sort of consider for the purposes of our notes? 1. If there are any transaction costs attached with the investment or any financial asset which has been measured at fair value through P&L, then such transaction costs at the time of initial recognition will go to P&L. Number 2, like we have discussed, any changes in fair valuation will also go to P&L. Clear on this? Yeah. Any questions from your side? Any doubts in case you have on this? No? Simple and easy to do? Yeah. As I told you that the other two buckets in terms of their accounting requirement are comparatively simpler. The first part is also simple. The accounting for amortized cost is also simple. It's just that we are required to do some sort of computations. Because we are involved in computations sectors, that's why that's an exercise which may be required to be done. Though it's not complicated, but still, the numbers are involved. So that's why I'm just considering the other methods to be comparatively much simpler. Yes. Any questions from your side on this? No? So then we can move on to the third bucket for its accounting requirements. And the third bucket was fair value through OCI, which is something on which we have not solved an illustration, so we can get on to that also. So we can pick up another illustration, number 18. Illustration number 18. This is page number 12.85. Okay. Yeah. Let's move on to this illustration now. Accounting for assets at fair value through OCI. Metallics Limited has made an investment in equity shares of a company, Castor Limited, for 19% equity stake. So M Limited has invested in equity shares of C Limited. I'm just making it M and C for Metallic and Castor. And they have investment of 19%. So they have invested in 19% of the equity shares of Castor Limited. Significant influence is not exercised. So that means when we say that this investment is made by M in C, C is not considered to be an associate of M. So you should consider it like any other normal investment. Investment was made for rupees 5 lakh for 10,000 equity shares on 1st of April 2000 X1. So on 1st of April 2000 X1, this investment was made. 10,000 shares were required for rupees 5 lakh. Amount paid was 5 lakh and the number of shares acquired were 10,000. Okay. Then it says on 30th June 2000 X1. So we are on 1st April. Now from 1st April we move on to 30th June. 2000 X1. The fair value per equity share is rupees 45. Rupees 45 per share is the value. So if we check per share value on 1st of April, what will it become? Rupees 50. So now in this case, what do we observe? That the value of equity shares when they are fair valued has gone down. So it is not necessary that fair value will always increase. It may behave in any manner. So it may go down, it may go up. So in this case, it's going down. The company has taken an irrevocable option to measure such investment in fair value through OCI. For the time being, please ignore this aspect of irrevocable option. Okay, for the time being, please forget it. I'll come to this separately. You can just simply say that this investment in equity shares of C Limited has been bucketed as fair value through OCI. So you may have a question on this. You may say that, sir, it's financial asset, no doubt, but where does how can we say that it will meet SPPI? This will not meet SPPI, correct? Because if we invest in equity shares of a company, then SPPI fails. Then how can we categorize it at fair value through OCI? So there is an option available in the standard for doing this. I'll come to that. For the time being, we are only focusing on accounting entries, measurements. So that's why for the time being, we can just ignore this aspect. I'll come to this slightly later. You can just assume that yes, it's fair value through OCI. And in case it's fair value through OCI, how should the accounting be done? Okay, yeah. So in this case, can you just quickly get onto this accounting and tell me the accounting entries to be passed at this on 30th June 2000 X1? Yes, what do you think will be an accounting entry to be passed on 30th June 2000 X1? Yes, let me just see who can answer this question. We have discussed about this accounting requirement. It's just that accounting entry needs to be passed now. So can you all please quickly tell me accounting entry on 30th June X1. So I'm just starting with accounting entry on initial recognition. And still waiting for a response. Today your responses are not so fast. So that's why if you can just send your response quickly, that will be helpful. On 1st of April 2000 X1, what do we do? On 1st of April 2000 X1, we will record investment in equity shares of C Limited debit at fair value. So what's the fair value? 5 lakh to bank. 5 lakh. Do we have any transaction cost in this case? No. So it's the recording of the investment that's completed at the time of initial recognition. Okay, now comes subsequent measurement on 30th June 2000 X1. Now on 2000 X1, what do we do? Great. So Chavi has given me the accounting entry. Chavi is saying, sir, we should book loss because of changes in fair valuation. What's the change in the fair valuation? From 5 lakh, it will become 4,50,000. So there's a loss of fair valuation equivalent to 50,000. Yeah. And because of this, the impact will be on the investment amount. Yeah, same is the response from Costa. Very good. So we will say fair value loss on investment in equity shares of C Limited debit, and we will reduce the amount of investment with this because we are measuring the investment at fair value to investment in equity shares of C Limited. This will be 50,000 and this will also be 50,000. Okay. Now this is a balance sheet component. So with this amount, the investment amount will get reduced. Yeah. Where do we take this? This will go to P&L. So you can also pass another accounting entry for transfer of this amount to P&L. So what will be the accounting entry? P&L debit 50,000 to fair value loss on investment in equity shares of C for taking this to P&L. So I have received the response from Pujita, Guru Raja. They are all giving the same answer. Very good. Costa, Rohit, they have also shared. Okay, great. Very good. Yeah. So I'm hoping with this you are clear on the measurement and you are also clear on the accounting requirements now. Yeah. So financial assets is all clear to us in terms of our accounting requirements. Yeah. Okay. So if the financial asset is all clear in terms of the accounting requirements, now what I can do is I can just add certain points over here. Let's understand what are those points. Now I'm going back to my discussion on financial assets with which we started. Okay, so you can just say that in a way we are going back to the concept of financial asset because I'm just adding certain more aspects to the understanding of financial assets. I'm not trying to just complicate it. Okay, so don't worry about it. Major part of the financial assets is completed. It's just that few things we can now add to that. Let's understand what are those things. And we've already completed that. So it's not something new. I'm just trying to now explain you what is it that we would have completed or we have completed and which you may not be knowing in terms of the way those are required to be presented. If you remember, we discussed one example of investment or security deposit. Okay, so this is security deposit, which we also called as lease deposit. Correct? And there was one example of investment. There was one example of investment in equity shares. Yeah. So for financial assets, we can say these are the examples. Example number 1, example number 2. Yeah. Now, if you look at lease deposit, from the holder side, there's no doubt it's a financial asset. And I'll need your help, and I'll need your quick help because that will help me to explain this in a better manner to you. So that's why your quick help will be required, and I'm hoping that you will help me quickly. can you tell me from the issuer side, what will lease deposit be classified as? From the issuer side, how will this be classified? Quickly. You all know about this. So that's why it's very, very important that you respond quickly. From the issuer side, how will you classify this? I'm not talking about holder, huh, please. For holder, we understand it's a financial asset. But the same financial asset from the issuer side will be considered as what? What do you call it as? How do you classify that? Yes, I'm waiting for a response. Quickly. Okay, great. Kostab has answered this. Kostab is saying, sir, I would call it as financial liability. Anjali is also there. Anjali is saying, I will also call it as financial liability. Very good. What about others? What about others? Any more responses? It's very, very simple, huh? Very, very simple for you to answer. What will you call it as? From the issuer side, we had a detailed discussion on all of these things. Yes, financial liability. Yeah. So we can say it was a financial liability from the issuer's perspective. Yeah. Okay. Can you give help me on one more point? Investment in equity shares for the holder is a financial asset. Again, yeah. For the issuer, how will you classify this? I think this is easier now. Easier than this. Yes, quickly. From the issuer's perspective, how will you classify this investment in equity shares? Some of your doubts related to mixing up of holder and issuer will also get resolved when you answer some of these points. From the issuer's perspective, this will be classified as equity. That is what Anjali says. So Anjali is saying this should be equity, sir, and this should be financial liability. Correct? And same is the response from Costa. Very good. We discussed that financial liability is what? It's a debt. It's a debt. It's nothing but a loan. And you should not go by the literal meaning of loan. By loan, we mean to say that it's a kind of borrowing arrangement. It's a kind of loan arrangement, or it's a kind of debt arrangement. So we can call this type of instrument therefore as debt instrument. Correct? We can call this instrument as debt instrument, and we can call this instrument as equity instrument. Okay, yeah. So what is it that we are trying to say, or we are trying to understand? That financial assets may involve investments in two types of instruments. Investment in debt instrument and investment in equity instrument. Yes or no? Easy to say this? And you will be thinking, sir, investment in equity instrument is understood, but why you are saying investment in debt instrument? Because what is investment? Investment means you have put money into an instrument. So if you have put money into a security deposit, that is what I am calling in simple English as investment in debt instrument. So you should not think that if I am calling investment in debt instrument, that will become equity share. No. Okay. We mean to say money invested in a particular instrument. So that's why we are calling this to be investment in debt instrument. Yeah. Now, whenever we will have any financial asset, what should we do? We should always check this classification of financial asset. Why? Because on the basis of this classification, our accounting will move. And please don't get confused with the classification that we have just discussed, those three buckets: amortized cost, fair value through OCI, fair value through P&L. They will continue to remain same. It's just that the first bucketing for any financial asset should be into these categories. Okay, should be into these categories. So I'm just rewriting this now. It's debt instrument. It's debt instrument, and this is equity instrument. Yeah. Any of these financial assets. So this is a financial asset. This is also a financial asset. Any of these financial assets may further be bucketed into three categories, or will have to be bucketed into three categories: fair value through OCI, fair value through P&L. And same is the case over here. They may be amortized cost, fair value through OCI, fair value through P&L. And when I am saying they may be, this means we need to check this, whether they are amortized cost, fair value through P&L, or fair value through OCI. Okay. Now, why are we adding this layer in between? So you may be thinking, sir, is it not simple for us to simply pick up a financial asset and straight away go to these buckets? That is simpler. There is no doubt that is also required to be done. But the reason for adding this layer in between of a debt instrument, of an equity instrument, is because standard allows us some options over and above the classification criteria that we have discussed. We have understood. Standard allows us some more aspects to be considered. Let's understand what are those aspects. Okay. We will know for sure that if it's an equity instrument, then the classification of this instrument cannot be amortized cost. That means this goes off. So I'm just crossing this. Cross means this bucket of equity instrument is not possible. Similarly, for an equity instrument, we can also say that the bucket of fair value through OCI is also not possible. Why? Because equity instrument or investment in equity instrument will always become fair value through P&L. No doubt about it. But standard gives us an option. What is that option? Let's try to understand. Standard says any investment in equity instrument will always go to fair value through P&L. Why? Because SPPI will always fail. But still, even if SPPI fails, an entity will have an option. What's the option? Option to designate such investment in equity shares at fair value through OCI. So this is over and above that classification criteria. This option will be available to the entity. But please understand that this option will be irrevocable option. Irrevocable option means something which cannot be revoked. What does it mean? Let's suppose on 1st of July, an entity invested in equity shares of P Limited and decided, entity availed this option and decided that it will classify this investment at fair value through OCI. Okay. Now with this, what will happen? Every time the change will arise, the difference will go to OCI. Every time the change will arise, the difference will go to OCI. So I think in the last illustration which we solved, we did not pass this accounting entry, but please remember that the change in the fair valuation of OCI of the equity instrument goes to OCI. I think that accounting entry we have not passed. So what I'll do is I'll also add that accounting entry now. Let's suppose after 1st of July, at any point of time, entity wants that it will classify this investment at fair value through P&L. That's not possible. That's not possible. So entity will have to now keep its investment in fair value through OCI till the time it's not disposed of. Clear on this? It's irrevocable. So it will continue to remain there, with the impact that every time there will be a change in fair value, impact will keep going to OCI. So let's see what the accounting entry that we need to pass. Accounting entry will be the fair value change. In our case, if you look at illustration number 18, you remember illustration number 18? In our case, the fair value change was a loss. So where do we take the loss? OCI. So what's the accounting entry will pass? To fair value loss, whatever is the amount. And here we will say fair value OCI reserve debit. Yeah, fair value OCI reserve. You can just put any name to this. Important thing is OCI will be debited instead of P&L in this case. And because you will take it to OCI, so that's why you will have to put a name to it. Yeah. Now the other thing is that one, this option is available to designate any investment in equity shares. Second, this option is available for investment on an individual basis, which means, let's suppose company has invested in two types of equity shares, or say equity shares of two companies, P Limited and, so this is A, and company has also invested in equity shares of Q Limited. Now, if the company wants, it may designate this one at fair value through OCI and may measure this at fair value through P&L. So this is not a designation. This is a designation. Why we are saying this is a designation? Because it's an option available to the entity which they have chosen. But this option is irrevocable. And secondly, this is available on investment by investment basis. Means for each and every investment, we can avail this option. And same thing can be done subsequently. But once an option is selected for that particular investment, that option cannot be changed. It has to remain like this. Okay. Third point which you need to consider over here, that is that if an investment in equity instrument is in the nature of held for trading, means if you are investing in equity shares of P Limited and your objective is what? Held for trading, then in such a case, you cannot designate that as fair value through OCI. Then you cannot designate that as fair value through OCI. Okay. So what I'll do is I'll just take you to a flow chart wherein we can just discuss all of these points. I think with the help of this flow chart, you should get more clarity around it. Yeah, so some of these points that we have discussed, let's see. What are we looking at the top? At the top, we are looking at equity investment, and this is nothing but the investment in equity. For which, what do we see? Contractual cash flows SPPI test, that will fail always. So that's why it will always go to fair value through P&L by default, correct? But we still have an option. But when is that option available? If any such equity investment is not held for trading. If that is held for trading, then we don't have any option and we should straight away come to fair value through P&L. But if the equity investment is not held for trading, then an option is available to measure that at fair value through OCI, and such option is irrevocable. Secondly, you must be knowing about recycling. At the time of disposal of this particular equity investment, at the time of disposal of this particular equity investment, which would have been classified at fair value through OCI, will not be taken to P&L. So that recycling of OCI amount to P&L, that is not available for this item. Yeah, you remember OCI, you must have covered in OCI that OCI will have two parts. OCI will have two categories. Some items which will be recycled to P&L later on, and some items which will not be recycled to P&L later on. So this is one of the items which will not be recycled to P&L later on. This will continue to remain in OCI forever. Okay, and when the investment is disposed of from OCI, it will move to reserves. It cannot go to P&L. Clear on this part? Any questions from your side on this? Any doubts on this part? If you will see our accounting, our criteria for classification, all of those discussions, we have not changed. All of them remain same. All of them remain same. It's just that we have brought in some more options, which I believe will now be easier for you to understand. Correct? I think Preeti, your doubt would have been resolved now. Preeti is asking, sir, what is irrevocable option? Irrevocable means if you have selected that option to be at fair value through OCI, you cannot take it to fair value through P&L. Because ideally, your investment in equity shares should have gone to fair value through P&L. Why? Because that's what the bucket criteria says, which we have discussed. But we designated it. Why we designated? That option was available to us. But let's suppose later on we decided to take it to P&L. We cannot do that. We cannot do that. So that's why we are saying it's irrevocable, which cannot be revoked later on. So option availed cannot be revoked later on. Okay. Then Preeti is asking, sir, what is the difference between accounting treatment of fair value through P&L? As we discussed, that the changes in fair value will go to P&L in case of fair value through P&L bucket, and changes in fair value will go to OCI in case of fair value through OCI bucket. I think that accounting entry we did not pass in illustration number 18, which may be bothering you. That's why I put that accounting entry for clarification. I'm hoping, Preeti, with this you are clear. Okay. Then Kaustav is asking, sir, what can be the benefit advantage for the entity to choose this fair value through OCI irrevocable option? Yes. Now, if you look at any financial asset which will be measured at fair value through P&L, so at every reporting date, what will happen? You will have to fair value that, and the resultant impact will go to P&L. So your P&L becomes volatile. And please understand that this may not be the nature of business of the entity to invest in equity shares. Maybe it's a manufacturing company which has invested in equity shares. And for those investments, fair valuation may be fluctuating significantly every reporting date. And because of that fluctuation, what will happen? There will be a significant volatility in the P&L in every reporting period. Now, if we want to avoid that volatility in the P&L, How can we do that? By designating it at fair value through OCI so that it will not go to P&L. So there will be no impact on the P&L. It will only stay in OCI. And for some of the companies which are into startup phase, when the investments are made in them, therein such type of options are generally selected. So if you look at practically, therein such type of options are selected because in such a case, volatility is higher. Volatility is higher in terms of changes in the fair valuation. Okay, clear? Clear on this? So Preeti is also clear on this part. Yeah, so I'm hoping that with this, all of you are clear. Now, in this case, I'll add one more part. And you may be thinking, sir, how many things will add? Because you said that financial assets are completed. Yes, those are completed. So don't worry. I'm not adding too much to this. I'm just bringing in one more sort of category on which, again, I will not get into too much detail. That's only for the purposes of your reference right now. In detail, we will have a discussion on that later on in our subsequent sessions. Now let's see what is that third part. Like debt instruments, like equity instruments, there can be another category of instruments which may be called as derivatives. What are derivatives? Please don't get into that for the time being. Okay, I'm not getting into the meaning of the derivative right now. I'm just keeping it simple that there can be another type of investment into another set of instruments which may be in the nature of derivatives. In case that happens, okay, then for derivatives, when you will understand about derivatives, please for the time being note down that SPPI will always fail. For derivatives, SPPI will always fail. And that's why they will always go to fair value through P&L bucket. Please remember that the classification criteria will remain same. That has not changed. So classification criteria for financial assets were 3. This, and this. So they will remain same. Those buckets will always remain same. It's just that I'm just breaking the financial assets into 3 types. These are not buckets, these 3 types. And for all of these types, we need to check the bucket because according to their bucket, accounting will happen. So the reason why we are picking up these types are because some of the types will by default fall into a particular bucket. Let's say if we talk about derivative instruments, they will always go to fair value through P&L. If we talk about equity instruments, they will always go to fair value through P&L. The only exception is that option. If that option is not availed, then this will always go to fair value through P&L. But this category is the one for which you will have to check all these things. Yeah, for this category, you'll have to check all these things. Clear? So that's why when you get into the types or when you understand which type does this financial asset belong to, your bucketing assessment becomes simpler because you will know that if this is equity instrument type, it should go to fair value through P&L or an option is available for this. But this one is not possible at all. If this is derivative instrument, then by default, it should be fair value through P&L. Okay. Clear? Yeah. And this by default, again, I'm saying on the basis of our understanding of the criteria of bucketing. Clear? Yeah. So let's understand this third bucketing also with the help of a flow chart. And the reason why I am, correlating all of these things to the flow chart is because eventually you will need summaries, you will need notes. And all of these flow charts which are there on the presentation and which are also there in your study material will help you significantly because all of these points So today, I think this is our third session on the financial instruments. All of these points are in a very nice manner summarized in the form of a flowchart, which I'll just show you. And if you just look at the flowchart, you will be able to revise each and every point in relation to entire discussion that we have had so far for the classification and the measurement of financial assets. Okay, so that's why it's important for you to understand these flowcharts. So for derivative instruments, what do we say? SPPI will fail, and you may not be able to understand why. That we will understand when we will get onto the derivatives. Okay, so now we have three buckets. So first bucket was, first type was debt instrument. For debt instrument, what do? We check this test. If this is passed, hold to collect, we take it to amortized cost option. Yeah, if this fails, we go to fair value through OCI. And if we add to our model sale, then fair value through OCI will come. Correct? Yeah. Now in this debt instrument, again, there is an option. What's the option? That some of the financial assets which are of the type of debt instruments, an option is available to fair value them, but that's a very remote possibility which you'll see. So that's why I'm just ignoring that option for the time being. Yeah, maybe later on we can just briefly speak about this option. I'm just not trying to confuse you at this point of stage. Yeah, so at this point of time, you should understand that debt instruments will get into these three types, the way we have discussed. Then we get on to another type, that is derivative instruments, which I said will always go to fair value through P&L. And then we discussed we have investment in equity instruments, which will always go to fair value through P&L, but we have an option to designate that at fair value through OCI. And now what we can see is a complete picture of all these three types. Can you see the types? Type number 1, this is investment in debt instrument. Type number 2, this is investment in derivative instruments. Type number 3, this is investments in equity instruments. So for these three types, what do? We do the bucketing of amortized cost, fair value through OCI, or fair value through P&L. So now this was the chart which I was referring to. You should make sure that at the end of today's session, okay, maybe after some time, but make sure that today itself you go through this flowchart very carefully. You are not required to refer to this flowchart right now, yeah, because it may take you some time to understand this, memorize and revise some of these points. But it's a very nice flowchart which brings out each and every aspect. Please understand each and every aspect related to classification and measurement of financial assets. Okay, yeah. So you can note down this flowchart for the purposes of your revision at the time of examination. Okay, all right. Clear on this? Any questions from your side on the financial assets? In case you have, please let me know. This second slide, which you can see on the screen, talks about the accounting requirements. So it's a summarization of various categories into which various types of financial assets may be bucketed, and depending on how they are bucketed, what will be the accounting requirements, whether you look at it from the balance sheet side or P&L side or from the OCA side. Okay, so this is again a summary for you. You can just go through this summary later on. This will also help you to revise all the accounting requirements. So these two slides become important for you. Okay, or you can just say these two slides are the summary slides for you. Yeah, clear? Okay, now as we discussed that depending on the change in the business model, financial asset may get reclassified. So that reclassification of financial assets you can mark. I'm just parking it to a subsequent session, not now, because there are a lot of points on it which are not really relevant for our discussion and which may just deviate us from the concept that we have been focusing on right now. So I'll not discuss the reclassification part. Once we are done with this complete financial asset, financial liability, equity, then I'll go on to the reclassifications also. Okay, for the time being, we can just park that reclassification we are doing later on. All right, yeah. So now what we can do is we can just look at your queries in case you have, and then we can take a break of 10 minutes. After the break, we will start with discussion on financial liabilities and equity in terms of their classification and measurement. So the same thing which we did for financial assets, now we'll do for financial liabilities as well as equity. You remember we said that now we'll have to pick up all of these items one by one. So financial assets is done completely except for its reclassification. Now what we are going to do, we will now get on to financial liability and equity. Okay, and the same thing we'll check for financial liability and equity. So before going for break, we can just quickly have a look at your questions, your queries, in case you have. Yes, tell me any doubts, any questions? Any doubts, any questions from your side? No questions, no doubts. Yeah, so you can just send your queries over here in case you have any query. Yeah, and after the break, then we can have a discussion on that. Fine. So let's go for a break. 10 minutes, please. So after the 10 minutes, we'll meet. Thanks. Hi, welcome back. So we can now continue with our discussion. And let me just go to your queries first of all. So Guru Raja is asking about holder and issuer view. He's saying, please tell about the holder issuer view of security deposit of lease. I'm not very clear on your query, Guru Raja. So if you can just clarify maybe even further, what is it that in terms of view that you want to understand? So are you talking about two different perspectives, two different accounting requirements, or is it like that we want to understand how this will become a holder for one, sorry, how this will be considered from holder's perspective and how this will be considered from issuer's perspective? So can you please elaborate on your query? Rohita is asking, so in respect of fair value through OCI model, whether few financial assets are to be held and few financial assets are sold, or financial assets held for some period and sold after some period. No, it's about in a portfolio, some assets should be sold and some should be held. It's not about that some assets are held for a particular period and then sold for a in the different period, because eventually it will mean the same thing, but the way you need to understand is, let's suppose portfolio you have 50 financial assets, then 20 are sold and 30 are held, or say 35 are sold, 15 are held. That gives you a mix of both the things which are done. Okay, so I'm just expecting Guru Raja to share me a detailed query, please, on the basis of which we can have a further discussion. All right. So now we will move on to the bucketing of the financial liabilities, or we can say the classification of financial liabilities. Now, similar to financial assets, financial liabilities are also required to be bucketed. At the time of initial measurement, this has to be fair value. Same thing like we do for financial assets. But for the purposes of subsequent measurement, the measurement will again be driven on the basis of this bucketing or on the basis of this classification of financial liabilities. But unlike financial assets, we have only two buckets of financial liabilities. And you may be saying, oh, great, thanks so much that we have only few buckets. And that's why it's a comparatively easier classification which we see in case of financial liabilities. So what are these two buckets? Amortized cost and fair value through P&L. So now for financial liabilities, fair value through OCI bucket is not there. So that means we cannot have a financial liability which will be classified into fair value through OCI. Yeah, simple, easy to understand. Secondly, in case of financial assets, we used to start with amortized cost, wherein we used to check business model, contractual cash flow characteristic test. Such things are not required to be done in case of financial liabilities. It's comparatively simpler. Let's see, how do we check it? We will first check fair value through P&L, and which used to be a residual category in case of financial assets. Here, what do we say? If there are any liabilities which are held for trading, you may be thinking, sir, how can liabilities be traded? So if you look at the financial institutions, they actually trade in their liabilities, because they are required to maintain certain reserves, certain assets position, certain liabilities position, certain net current assets position. That's why it's very common for financial institutions to have this trading of liabilities. Though for non-financial companies, yeah, you will not see this liability getting traded. You will not see such type of transactions. But for financial companies, Like for example, if you talk about NBFCs, banks, etc., you will see such type of transactions. Those liabilities which are held for trading should be measured at fair value through P&L. Number one. Any derivative which is in the nature of liability, that should also be measured at fair value through P&L. And this was the same thing which we discussed in case of financial assets also. And you may have a same question now. But sir, we don't know about derivative. Yes. So I'll have the same reply now, that for derivative we should wait. I'll go to the derivative slightly later. Okay, not now. For the time being, you can just say that business combination in AS 103. Yeah, you must have covered business combination in AS 103. Even if you have not covered, don't worry. What you need to then remember is that in a business combination, there is a concept of contingent consideration. Means the company which acquires another company, the company which acquires another business may pay consideration of two types. First, which is paid upfront or which is agreed. Let's suppose to buy a business, a company has paid rupees 50 crore. So this is agreed and paid. Another type of consideration could also be agreed, but which is dependent on certain conditions. And that is required to be paid only when those conditions are fulfilled at a future date. If those conditions are not fulfilled, then that consideration will not be paid. Yeah. And because this is contingent on the future arrangement, that's why such type of consideration is called as contingent consideration. So under Ind AS 103, this has been discussed in detail. Any such type of contingent consideration is required to be recognized by the acquirer. So when the acquirer will do the acquisition accounting in Ind AS 103, along with that agreed consideration, which is not contingent on any future event, along with that, this contingent consideration is also required to be recognized. Okay. And that is done in case of acquisition accounting. That contingent consideration, if that happens to be a financial liability, okay, if that happens to be a financial liability, now again, in such a case, this is required to be assessed whether it will become financial liability or an equity. Okay. In case that becomes a financial liability, then it will always be bucketed under fair value through P&L. So we can say in a way there are three items that we have talked about. All of them will go to fair value through P&L. And any other financial liability will go under amortized cost. Any other financial liability will go under amortized cost. Simple, easy to understand. Yeah, there's no complication in this case. It's relatively easier. Yeah, easy to understand. Okay. Now, in case of measurement, we have the same criteria for accounting and measurement, which we discussed in case of financial assets. In case there is a financial liability which has been classified as fair value through P&L, then any change in the fair valuation of such financial liability at every reporting date, because such financial liability will have to be measured at fair value at every reporting date. any change in fair value of such financial liability at every reporting date will be taken to P&L. The same accounting which we did in case of assets, now we will do for liabilities. So let's suppose earlier the liability was measured at 100. At the year end, its fair value becomes 110. So there is an increase in the liability. So there is a fair value loss. Where do you take it? P&L. Okay. In case the fair value has gone down, then it will become gain because it's a liability. So the value of liability will go down and the gain will arise, and the gain will also go to P&L. So fair value changes, whether it's a gain or loss, will go to P&L. Number one. Let's talk about amortized cost. Now, what is this amortized cost? This amortized cost accounting is, you can say, mirror accounting of the accounting which we saw in case of amortized cost accounting of financial assets. You can say you will do mirror accounting. Now, what do we mean by mirror accounting? Mirror accounting means if the other party has recorded asset, we will record as liability, and if they have discounted it, we will also discount it, and the change in the discounted amount, they took it to expense, we will take it to income. That's what we call as mirror accounting, and I'll also go to that accounting for the purposes of our discussions. Don't worry, we'll go to the accounting criteria also. For the time being, we are just looking at the concepts, and all of these are nothing but the summaries for the purposes of your revision later on. Yeah. Okay, so let's now understand the mirror accounting and also understand the accounting for amortized cost liabilities. So financial liabilities which are classified at amortized cost. And I think this will also clarify your doubt, Guru Raja. Guru Raja is saying how one is holder and the other is issuer. This is still a confusion, sir. Yeah, sure. So this confusion should hopefully go, because I remember in the last session also, one student had this confusion. I don't remember who was there, and I'm sure many of you will continue to have this confusion, though many of you may not be speaking right now, but many of you will have this confusion. And even if this confusion goes away, this confusion may come later on, and that's why I told you at the beginning of this topic that in this topic the most important aspect for you to analyze first will be to check who are you checking the accounting requirement for. Are you checking that for the holder or are you checking that for the issuer? Okay, so that's why it's not very uncommon for you to have this confusion. So don't worry, it's very normal to have that, and it's very easy to understand. So with the help of this mirror accounting example, I'm hoping you will get some more clarity. So in the example for financial asset, we discussed there was a lease deposit. Yeah. And this lease deposit was given by A Limited to B Limited. Okay. You can just simply say in very, very simple terms that A Limited, who is the holder, should always have the asset. Or in other words, for an entity for which an asset will arise, will become the holder. If you want to write down in your notes, you can note this, because you will not see this point on my presentation, because it's for the purposes of our understanding only. So if you want to just write this for the purposes of your notes, you can write that for the holder, instrument will always be an asset. Instrument cannot be a liability. Instrument cannot be an equity. For an issuer, Instrument can only be a liability or an equity. It cannot be an asset. Okay, so this is A Limited. For this, it was a financial asset, so that's why we can say it will be holder. And I have put this flow chart only for the purpose of your understanding. I have brought in asset first to convey to you that you should understand that because it's an asset, that's why it will become holder. And because it's a holder, that's why it will also be an asset. Now for B Limited, who has taken this lease deposit from A, after 5 years, B will be required to pay this lease deposit back to A Limited. So that means for B, what is this deposit? Liability. And because it's through a contract which B cannot avoid to pay, that's why it will become financial liability. That's why it will become financial liability. And that's why you can say we are looking at B as an issuer. Yeah, Nuraja, I'm hoping you are clear on this, and I'm hoping all of you are now more clear on this. Yeah. Okay. So now I was talking about mirror accounting. So we discussed the accounting for financial assets. Now for financial liability, let's see how the accounting will work. And I'm using the same numbers. Lease deposit was 10 lakhs for a period of 5 years. Its present value came out to 5,70,000, and the difference was taken to prepaid lease equivalent to 4,30,000. Correct? Yeah. Now let's understand for B. How is this accounting required to be done? Now for B, on day 1, 10 lakhs has been received. On day 1, an amount of 10 lakhs has been received. And after 5 years, B will be required to pay back 10 years. But can we say that if you take a loan, it's a kind of loan, isn't it? It's a kind of loan. If you take a loan of 10 lakhs today, the same amount will be required to be paid back by you if that is interest free. The answer is no. Because that means an interest component is included in this. Same principle. An interest component is included in this. So after 5 years, this is getting repaid, including the interest component. And what is that interest component? This is the interest component. How do we derive this? We compute its present value, which will come out to 5,70,000, assuming the interest rate to be same for B Limited. Because interest rate could be different for A and B. Why? Because IRR may not be same for each and every entity. IRR may vary entity to entity, correct? Now, considering the interest rate is same, 12% for B Limited, what will happen? On day 1, B Limited will record a liability of 5,70,000. So what will the accounting entry which B Limited will pass? Let's understand. Bank debit, and this is initial recognition. Bank debit 10 lakhs because it has received 10 lakhs. So it will have to record 10 lakhs, correct? And it will record lease deposit, security deposit at fair value, because initial recognition has to be at fair value. So that means present value. Its present value is what? 5,70,000. Yeah. Now, what do we do about balance for For financial asset, we called it as an expense, which was required to be deferred, which was required to be amortized over the contractual period. So let's do the same thing for liability also, for issuer also. If we have to do the mirror accounting, let's call it as an income, because if that was an expense for A, it should become income for B, and this income should not be recognized upfront. This should also be deferred over the period of the lease. So what do we say? To deferred income, 4,30,000. 4,30,000. Okay. So that is how it needs to be recorded. Clear? Yeah. Remaining accounting entry will go in line with what we discussed for financial asset. And why do we call it as mirror accounting? I'm hoping that now you will be clear. In that case, in case of financial asset, bank was paid, now bank is received, so mirror. Lease deposit was asset, here it's a liability, same amount, that's one mirror. Prepaid expense was expense, it's income. Income is also deferred, that's why it's mirror entry. Clear? Yeah. Let's see subsequently how will the accounting happen. Subsequently also same principle will continue. I'm assuming the interest rate to be same. Now subsequently, if we have to do mirror accounting, what should we do? This lease deposit should be accreted with interest, because it's recorded at present value, so we should load interest on this. Only then it will become 10 lakhs. What is our objective? To make it 10 lakhs after the end of 5 years. So what do we do? Accrete interest on this. So how do we accrete interest? By booking a finance cost. So in case of holder, it was a finance income. Now in case of issuer, that means B Limited, it will become finance cost. So finance cost debit to lease deposit. How do we get it? 5,70,000 into 12%, which I remember was somewhere around 68,000 approximately. Correct? So approximately this was the amount. Yeah. Same mirror entry. Next, what should we do about this deferred income? Amortize it, but amortize it on straight line basis. So we will have to now debit this deferred income, and I remember this amount was 86,000 approximately. 86,000 approximately. And now we will record income. So this will become lease income to lease income 86,000 approximately. Year on year, this accounting entry will be passed, which will make this deferred income as nil at the end of 5th year, and which will make this lease deposit equivalent to 10 years, equivalent to 10 lakhs at the end of 5th year. And at the end of 5th year, what will happen? Over and above these accounting entries, which will be repeated every year, lease deposit will be debited and bank account will be credited for its repayment. And this was also an entry which was passed. So can you see the mirror entries? Yeah. Or can I now say that if we have understood the concept of amortized cost accounting in case of financial assets, then its accounting under financial liabilities is almost similar. Yes or no? Yeah. Clear? Yeah. Okay. Any questions from your side on this? Any doubts? In case you have on this, please let me know. So these are all simple things. You may be thinking, so these are all so simple. So we don't have any query. And I'm just hoping that you are finding all of these things to be very, very simple. Yes, still, if you have any questions on this, please let me know quickly. Then we can move on to the next part. We will pick up another example for this financial liability. And I'll just tell you as to how the accounting may slightly change in case of financial liabilities, in case of amortized cost. Yes. Waiting for your query, if any. No? All right. Perfect. So then we can move on to the next example. So I think you can now move on to one illustration. This is illustration number 22 on page 12.89. Illustration 22. Yeah. Illustration 22, page 12.89. You can just read this one. Though I'll not be solving this, but after we are done with the discussion that I'm planning to do, this is the illustration that you'll have to start and solve on your own pace. Okay. So let me just take you to one similar sort of example for the purposes of our discussion. Okay, so let's look at the screen now. Another example of financial liability. So it's about a loan taken from a bank for ₹1,000. Transaction cost is ₹50. And at the end of 5th year, means at the end of the term of the loan, there will be a bullet repayment. Means entire 1,000 will be paid in one go. Bullet repayment will be there. The interest will be paid year on year. Contractual rate of interest is 10% and effective rate of interest is also given in the question, equivalent to 11.35%. Now it's a new concept which has come in and which is again a very important concept under financial instruments. Effective rate of interest. So we will now try to understand this concept. Okay. So we are saying loan amount is 1,000. There is a transaction cost of 50. Term 5 years. Yeah. Now, when this loan is taken from the bank has given a rate of 10%. Means as per the contract, the rate of 10% will be charged on this loan every year. So this is 10% per annum. Okay. Now this is something which I'm not sure whether you might have dealt or not during your articleship or during any of your discussions with the bank or any financial institution. See, whenever you take any loan, or maybe you can just, check this. Whenever you will take any loan, there are two types of costs that you will be required to incur. One cost is in the form of interest, which is required to be paid throughout the period of the loan, and which is very, very commonly known. There is another cost which is required to be paid. That is called as upfront fees. Whenever you go to a bank and take a loan, then on day one, when your loan will be processed, bank charges a fee which is called as processing fee, and which has a different names to it. Some of them may call it as upfront fees, some of them may call it as processing fees, okay, some of them may call it as sanction fee. So there are different names attached to it. But why is that fee charged? That fee is charged because you are entering into a contract of taking a loan from the bank. So that is in the nature of cost of having that transaction with the bank, and it's a one-time cost. So it's not charged on an annual basis, only one time. So if you have a loan of 5 years, it will be charged on day one. Correct? Now there are two ways to deal with this. Either the bank will pay you 1,000 and take rupees 50 from you. Either the bank will pay you rupees 1,000 and pay 50, and you will be required to pay 50, or what the bank will do is bank will pay you rupees 950. Bank will pay you rupees 950. It's one and the same thing, huh? Okay. Now let us try to understand the substance of the transaction, because every time we speak about substance. So let's apply that substance over here also. And I need your attention, and I need your inputs also on this, because some of you might have picked up this point. See, when you are taking a loan from the bank, all this while you may be thinking that what was your cost of entering into a loan arrangement with the bank? 10% per annum. This is something which we generally consider as our cost for taking a loan. But are we really correct when we limit our understanding to only the cost which is in the nature of interest? The answer is no. There are two costs which are attached. One is transaction cost and the other cost is interest cost. Two costs are attached. So even though contractually we are required to pay 10% per annum, effectively means what do we end up paying? Do we only end up paying 10% per annum? No, it will always be higher than that. Because if we mix these two costs, if we combine these two costs, then can we say that our interest rate or the rate at which we have paid a cost to the bank is only 10%? No, this will always be higher than 10%. Or I can say this will always be higher than the contractual rate. This will always be higher than contractual rate. In case processing fees or the transaction cost is 0, then what do we say? It can always be higher than or equivalent to contractual rate of interest. So that means there are only two possibilities. Either your effective cost, so I'm just using this term, either your effective cost will be equal to contractual cost, and what is contractual cost? Rate of interest. Or this can exceed your contractual cost. Or this can exceed your contractual cost. Correct? Yeah. That's why we are changing this to this. Clear? Okay. Now with this understanding, only Ind AS works. Ind AS doesn't go by the contract only, you remember? Ind AS goes by the substance. So in substance, an entity is not paying only the contractual cost. Entity ends up paying effective cost. And that's why in a loan type of arrangement, you will always be required to compute effective rate of interest other than contractual rate of interest, which I discussed just now. It may either match with the contractual rate or exceed, but it cannot be lower than contractual rate of interest, because bank will never pay transaction cost to the party. Bank will only charge it. And generally, it will be some amount. It may be a significantly lower amount, but it cannot be nil. Generally, you will see transaction cost in any loan arrangement. Okay, yeah. In fact, if you go talk to a banker, and let's suppose if you start negotiating on interest rate, so what the bank will do? They will reduce the bank interest rate, but they will increase the processing fee. Okay. And in case you start negotiating on the processing fee, they will reduce it, but they will increase the interest rate. That's how the negotiations generally happen with the banker. That's why both these costs are required to be considered in a combined manner when looking at the term of the loan arrangement. Okay. Now, with this understanding, we will enter our accounting requirement. So now we are entering into our accounting requirement. Now, if you look at the accounting requirement, what do we see? So there was a loan of 1,000 rupees, okay, on which 10% interest is required to be paid over a period of 5 years. Correct? This is interest, and interest as per the contract. This is not the effective interest. This is interest as per the contract. Correct? Secondly, at the end of year 1, what will happen? This will become 1,000. This will again 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 become 1,000. And in this case, I am assuming that interest will be paid year on year. Okay. In case interest will be paid year on year, then this is how my closing balance will look like. So my repayment will be 100. My repayment again is 100. My repayment again is 100. Repayment again is 100. Repayment again is 100. So my closing balance is 1,000, and at the end of 5th year, my repayment will be 1,100. Why? Because I am required to pay this in one shot, because of which it will become nil. Correct? Yeah. Now, we also understand the fact that this 1,000 is not received by us. In fact, we receive this amount net of transaction cost. So what do we receive? 950. Correct? On this 950, we are paying contractual interest rate of 100, which is true. And we are making a repayment of 100. So what will happen? Now, year on year, my closing balance will be 950, 950, 950, and 950. And why I am making this as 950? Because I am looking at the actual cash balance available against the loan arrangement. Instead of looking at the loan amount, which is not available in cash form to me, I am looking at the cash balance available. Correct? Now, what does Ind AS require? Ind AS requires that when you will do the accounting, you should ignore this contractual interest rate. Instead, you should book your interest cost using effective cost rate. Effective cost rate means you should derive that revised rate of interest which combines both the costs, interest as well as that processing fees. And how do we do that? For this, we need to get into that computation. Yeah. So for this, what I'll do, I'll just take you to that example once again. And in this case, we will also look at the accounting entries. So on day one, what will be the accounting entry? Initial recognition. Bank debit to borrowings, 950. And you may be thinking, sir, will we not record the transaction cost? So transaction cost is recorded in the form of bank entry only. So the net amount of borrowing has been recorded by us. Yeah. Now, step number 2. So this is step number 1. So this is done. Now, what is our step number 2? Step number 2 is not to pass an accounting entry, but to prepare this working. So this is our working which will now be required. How do we prepare this working? On similar lines. But in this case, in the example, on the board, we did not compute effective interest rate. And you may be thinking, but sir, that is given in the question. Forget what is given in the question. You can also compute it on your own. This interest is again nothing but IRR. And let's see, how do we get it? We need to compute an interest rate using which our closing balance at the end of 5th year should become 0. And if we start with opening balance of 950 with the given contractual cash flows. I'm repeating my point. I'm saying we now need to compute an interest rate. I'm not saying interest amount, interest rate, using which my closing balance of the loan should become 0 at the end of the loan term. Starting with opening balance of 950 and also considering contractual cash flows over a period of 5 years like this. Yeah. So if we do that, our interest rate should come out to be 11.35%. Because when we will take a rate of 11.35%, only then my closing balance will become nil. So what do? We will apply 11.35% on 950. So now this 11.35%, if applied on 950, can you see what is the number? So please compute it. On 950, 11.35%. So this comes out to 107.82. Correct? And which is not really matching with the number given on the table. Why? Because there is a round off difference. If you take more decimal places for this interest rate, the number will change. Okay. Now, year on year, for the purposes of our accounting, we will consider this interest expense. This will go to our books. And you may be thinking, but sir, actually we are paying 100. How can we charge interest rate of 107? How can we book interest expense of 107? Will it not be incorrect? No. That's why, again, another thing which we need to check. Can you all take this total of third column? Yes, quickly. Can you take the total of third column and tell me what will be the total of this third column? This third column. Yes, quickly. Can you give me the total of this third column, please? I think you will get your response once you compute the total of this third column. Yes, I'm waiting for you. Can you compute this amount and let me know? All of you, I want you to compute this one, please, and share with me. Yeah, quickly. What will be the total of third column? I'm waiting for a response. Okay, great. Costab has answered. Costab is saying, so the total of third column comes out to 550. Yeah, and I'm ignoring the decimal places because that is all because of round off. Now, if you look at the contractual interest amount, what will it become? 100 per annum. That means 500. But in this column, your total interest expense is exceeding the contractual interest amount by rupees 50. And what is this rupees 50? This is that transaction cost. You remember that transaction cost is also required to be recognized. And how do we recognize it under Indian GAAP? Under Indian GAAP, we used to charge it off to P&L straight away on day one. But under Ind AS, we don't do this. Under Ind AS, in a way, now that transaction cost has got included in this interest expense column number 3. And in a way, this is also getting recognized in an amortized manner. This is not getting amortized on a straight line basis. If you can look at the numbers, every year we are not adding the same amount to rupees 100. This amount is changing. How do we amortize this? Actually, that is getting amortized on the basis of the contractual cash flows which are involved. Yeah, it is getting amortized on the basis of contractual cash flows. Yeah, so why is this third column higher than the contractual interest amount? Because this includes transaction cost of rupees 50. Okay, and that is what we understood is our effective interest cost, or that is we understood is our effective cost of taking this loan. In simple terms, this is called as effective interest rate. So now what will be our accounting entry? So now at the end of year 1, end, our accounting entry will be interest expense debit. What's the amount? 107.97 to liability, to interest liability, which is nothing but a borrowing. Okay, yeah. And out of this 107, what is the amount that will be paid? Interest liability debit 100 to bank 100, because actual cash flow is only 100. So remaining amount is actually getting accumulated, and that is getting added back to my initial recorded liability of 950. Why? Because at the end of 5th year, I need to have this 950 converted into 1000. Only then I can pay 1000 at the end of the 5th year. Yes or no? Yeah. Now clear on this. It's the same principle which we discussed in our example number 1 of lease deposit liability. Though this example includes transaction cost, that's why we have recomputed the interest by taking effective interest rate as against contractual interest rate, and that is why this computation has slightly changed. If we take out the transaction cost, if we make it nil, then it will become very simple. Same working will come which you would have done under Indian GAAP. So you can redo this example by taking transaction cost as nil. You can recreate this table by taking transaction cost as nil, and you will understand all of these differences, because all of these interest amounts will in that case become 100 a year, 100 per annum. Yes or no? Yeah. Clear on this part? Clear on this accounting requirement? This is what we call as amortized cost accounting for a financial liability. Okay, all of you clear? Any questions, any doubts in case you have on this, please let me know. Because as I told you, once we are done with this example, then you will have to solve one illustration on your own. So you should mark Illustration number 22 as your homework on page number 12.89. Okay. Yeah. And I'm hoping that you would have read this and you would now understand about this illustration also, why I said this is on similar lines with the example that I have picked up now. Clear? All of you? Yeah. Any questions, any doubts on this? Please let me know. Any questions, any doubts in case you have on this, please let me know. Kaustav is asking, sir, in the exam, will we be required to compute the effective interest rate or will it be given in the question? So that may vary. Huh? So in some cases, you may be required to compute. In some cases, it may be given. Huh? So as we move forward, all of these aspects, you will get clarity on. Huh? So we'll attempt all types of questions. So don't worry about it. Okay. Yeah. And this interest rate, effective interest rate computation is similar to what you see in case of financial management also. The principle is exactly same. So it's not anything to do with the accounting. Actually, in accounting principles, because we are going to the substance, that's why we are required to pick up those financial management principles also. Yeah. Any more questions on this? No, clear? Okay, perfect. So then we can just now move further. Okay, Challa has a query. Challa is saying, so transaction cost in this example becomes a finance cost instead of direct cost as per ICAI. What do you mean by direct cost? I think you mean to say other than finance cost as per Indian GAAP. Yeah, which is true if you want to say that. So in this case, this transaction cost is forming part of the finance cost. And if you look at the Indian GAAP requirements also, because it's a cost related to the loan arrangement, that's why it should be treated as finance cost only. Clear? Yeah. The only difference in the treatment is that under Indian GAAP, you just straight away take it to P&L, whereas under Ind AS, you are amortizing it using a particular cash flow pattern of the depending on the loan arrangement. So that's the only difference I would say which arises here. Fine. Yeah. Okay. So then now, similar to financial assets, another requirement may arise for financial liabilities, that because financial liabilities are into two buckets, fair value through P&L and amortized cost. So they should also be required to be reclassified. The same thing that we discussed for financial assets. So we have not got into the details. Now this is different. For financial liabilities, you will not see a reclassification. So financial liability, once classified into a particular bucket, stays there. So you don't reclassify a financial liability from one bucket to another. Yeah. So that's why we will not be required to get into that discussion. So we'll just not discussing that part again on the reclassification of financial assets. So that is again part for some time. But for financial liability, you should understand it will not arise. Okay. Now, for equity, the initial measurement for the equity is what? As per the cost. And the subsequent measurement for the equity will again be at the cost. For equity, we don't do the fair valuation. For equity, we don't do the amortized cost. And please remember that when I'm talking about equity, I'm looking at issuer's perspective. Because for holder, there is no equity. There can be investment in equity. But when we talk about this term only equity or only liability, I'm hoping that now you would be very much clear on this, that these two terms are only used from the perspective of issuer. Okay, so that's why we don't need to get into details of this measurement of equity, but now we will further do a deep dive into this concept of liability versus equity. And deep dive means that whatever we have understood about liabilities and equity was a broad concept. There are so many aspects, there are so many transactions, there are so many points which may be attached to liabilities as well as equity, on the basis of which issuer is always required to differentiate between these two. Okay, so in a way you can say we are going back once again to our discussion on financial liability as well as equity. And that's why at the beginning of the session, you remember I told you it's extremely important to understand these three definitions, because everywhere you will see these definitions coming. And everywhere you will see us going back to that concept. And there's a purpose now why I'm going back to this concept. Because in a way, now I'm picking up Ind AS 32. As I told you, we have not been differentiating in terms of our discussion under this topic, whether we are talking about 109 or 32, but still for the purpose of your understanding, you should know whether it falls under 109 or 32. And why I am getting onto the this discussion on Ind AS 32 is because there are various points using which issuer, now the moment I say Ind AS 32, we should talk about issuer. There are various points which an issuer considers for differentiating a liability from equity. Okay. Now, coming back to our discussion that we did earlier. If the issuer will be necessarily required to pay cash, I'm only talking about paying cash. If the issuer will be necessarily required to pay cash in a given arrangement, then it will be financial liability. So for an issuer, I can use this term that if he cannot avoid payment, okay, one is that he will be necessarily required to pay cash, or I can use the term if he cannot avoid payment of cash, then what will it become? Financial liability. Okay, but if he can avoid, payment of cash, then it becomes equity. Correct? And we also discussed some examples around this concept. Yeah. Ind AS 32 is all about difference between equity and financial liability. So majority of the standard keeps discussing this difference. So that's why you also need to understand now that even though we have understood their definitions, still there are so many points of their differences that we are now starting with, and with which you will get more clarity about your understanding of liability as well as equity. But you should not get confused about their meanings and about who we are addressing right now. So now we are addressing the accounting requirement of issuer please. That you should not forget. Okay. So let's read some of the points which are there on the screen. The classification of an instrument as equity or a financial liability. Yeah. Classification of an instrument as equity or a financial liability would not be impacted by some of the terms which are given below as an example. History of making distributions by the issuer. Distribution means dividend. Intention to make distribution in the future by the issuer. Possible negative impact on price of issuers' ordinary shares if the distributions are not made in the future. Amount of issuers' reserves. Issuers' expectation of a profit or loss for a period. Ability or inability of the issuer to influence the amount of its profit or loss for the period. So the standard says that whenever you will differentiate between liability and equity, you should only go by the contractual terms. You will not look into these aspects. These are irrelevant. Okay. And let's understand this point with the help of this example. Okay. Yeah. And all of you need to answer this, please. This is very, very simple. There's no new concept which has been added here. That's why I would request all of you to please answer this. Chal, I'll come to your query. Company A issues non-redeemable callable bond with a fixed 8% coupon. Coupon can be deferred in perpetuity at A's options. That means company has issued non-redeemable. Non-redeemable means which will not be redeemed. It's a bond. It carries interest rate of 8%, but this can be deferred in perpetuity if A wants. A is the issuer in this case, has a history of paying interest each year. And based on this trend, current bond price means the instrument which he has issued is predictable on the holder's expectation that coupon will be paid and continue to be paid each year. There's also a stated policy of it. Please mark it up. Stated policy of A, that coupon will be paid each year. This policy is also available in the public domain. In this case, we need to comment about this bond. From the issuer's perspective, whether this bond will become liability or equity. Quickly, over to you. So we are moving close to the end of the session, and I want this quick response from all of you. And I want all of you to please participate in this. Yes, quickly. All of you, please answer. What do you think about this instrument? Will it become financial liability or an equity? Yes, quickly, please. All of you, please tell me, will it become financial liability or equity? Tell me. Yes, all of you, quickly tell me, what do you think? It will become financial liability or an equity? And you can also specify your reason, please. But you need to be quick. I think it's very, very simple. We have already discussed at length about equity as well as liability. Challa is saying, sir, it has to be a financial liability. There is no doubt about it. Very good. What about others? What about others? So, I think you are taking a lot of time to answer this, which I didn't expect. I thought you'll just immediately answer this. What has happened? Where are you stuck? Tell me quickly. Where are you stuck? What do you think about this financial liability or equity? You remember the definitions of financial liability and equity? Just apply that principle over here and you will get the answer. Very good. Anjali is also saying, sir, it has to be a financial liability. What about others? Reasons are not being mentioned, but still answer is coming, which is good. Yes, quickly. What do you think about this? Financial liability or equity, and why? You can just specify. Financial liability or equity? Yes. Yeah, because we are moving close to the session, so let's quickly understand this. For this bond, A may be required to pay two things. For any instrument, any issuer will always be required to pay either of these two things, principal or interest, or both of them, correct? Now in this case, if we look at the contract, is the principal required to be paid? No, it's non-redeemable. So if A wants, A may not pay. Yeah, because contract doesn't require him to pay. Okay. Number two, interest. If you look at the contract, what does it say? Coupon can be deferred in perpetuity if A wants. Means A can avoid the payment of interest if A wants, as per the contract. Yeah. So that means interest is also not payable. Neither interest nor principal are payable if you look at the contract terms. However, there are a lot of information available that A has a history of making payment. A also has a policy. It's the expectation of the holder that A should pay. Does it really matter to us? We just looked at it. That any of these things should not impact our assessment. We only need to go by the contract. Whether as per the contract A has any ability to avoid payment of cash, which is clearly there. A has the ability to avoid payment of both principal and interest. So if both are not required to be paid by A at the option of A, so what will A call it as? A will call it as equity and not a financial liability. All of you, now you are clear on this. Yeah. So we will have similar sort of discussion on the differences between financial liability and equity in our next session. And that's why I told you that India's 32 focuses only on this point. Yeah. But it's very important that you come after revising both these definitions. Okay, clear? Yeah. Now I'll just quickly go to the query of Challa. Challa is saying, sir, I have a doubt practically. Commission charged by the bank for giving guarantees which are given to our customers for receiving advance from them. Is this a finance cost or other cost? Please explain. See, as I told you, if you reach out to a bank and bank charges you anything, you can give any name to that. You can call it as processing fees, you can call it as upfront fees, or anything you call it. If the bank is charging a fee for that transaction, for giving that loan, what is that cost? That is called as borrowing cost. What is a borrowing cost? Finance cost. For this, you can also refer India's 23 borrowing cost. You can also refer our Indian GAAP accounting standard for this. They are both same in terms of this understanding. There is no change. So this should be a borrowing cost if this cost is being paid for the purposes of obtaining loan. Okay, clear on this? Yeah. And with this, we can just conclude our discussion for today. And in the next session, we'll continue with this difference. We'll practice a lot of questions, but it's very, very important that you come after the revision. Otherwise, the same thing will happen, which has just happened on this case study number 1. Clear? All right. Yeah. So thanks to all of you once again for your time and for your wonderful participation. Thanks so much.